Yahoo's CEO Scott Thompson resigned after an inquiry into his academic credentials by an activist investor. Spanish bond yields rose above 6.2% for the first time in more than 5 months. I'm Lindsay Bell, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Lindsay Bell with The Street, and together we bring you the morning call. Over the weekend, we got 2 big data points. Well, there's a lot of news out of Europe, but one of the biggest things was that Merkel kind of lost some support in Germany, and China, they cut their required reserve rate to support economic growth.
Well, I think both of those are very important. If you recall, switching gears about a week or so ago, maybe 2 weeks ago, when Greece finally said, you know what, we have a package, it's great, thanks for taking the haircuts, but we don't want to pay you back. And then you had it in France, them voting out Sarkozy, saying, you know what, we want to just tax and spend now. We don't want to be committed to deficit reduction. We don't want to be committed to austerity. It's not really working yet. Let's not give it the time. And right then, when I think I changed my tone, that's when I got more defensive. And that's when also the technicals started to roll over as markets or different sectors started to break down. So whenever you have the fundamentals and the structured broken systems line up with broken technicals, you get out of the way, you get tactical, and you become safe.
So what are the levels that you're going to look at today going into the trading day?
Well, if you take a quick look at the chart of the S&P, you'll see, this is the chart we follow all the time. And we try and talk about trends, and this is when the uptrend started back in October. And if you recall, it broke right here. So it broke actually in late March, and also that's after the first quarter. The first quarter was beautiful. Remember that quarter? It seems like it was so far, so far away when we were able to have a portfolio approach. You had a nice methodical move to the upside. You know what? That broke right here. And then since then, you've had a very choppy tape where you had a retest of that old high right there. Okay, and if you recall, I was going away to the Bahamas, and I hate to yell at people, but we talked about having a stop at 1390 to 1394. This was the day the ADP came out, and it wasn't really that good. Actually, that was that day. Here's the claims, and here's our jobs numbers. So these 3 days technically broke this market down. That was your way out. This was also the day that IBD went to correction mode. So, Lindsay, we've talked about patterns, we talk about macro patterns, and what's the last technical macro pattern we talked about?
The last technical macro pattern is the downtrend, the 50-day.
Exactly, as well as the head and shoulders top pattern. So we've talked about that pattern. I went out in the news with it on CNBC Asia last week. I also talked about it with Patty Don from CNBC. So if we have time to talk about it, you have time to press your keys and react to it. So if you go back to the chart, you will see that here is that technical head and shoulders pattern. Here's the left shoulder, here's the head, here's the right shoulder. We talked about necklines. This 1360 was that neckline. We broke below it. And then last week you had choppy trade both ways. We actually had some nice success using our pivots, but we hovered below this neckline, below that 1360. So now if we could trade on a 60-minute level and close below 1343, the measured move of this pattern from 1420 down to about 1360 actually takes you all the way down to about 1300. So 1300 would be the measured move of this pattern, and along the way you have a stop at around 1320, which would be right around here. So we've been sending this out and off the charts. We've been trying to get people on this page, and hopefully you're a little bit prudent, you're in cash, and you can embrace this type of correction.
How about we get a little more analytical though and look at the fib levels?
You know what, the fibs are important because that's where institutions look at levels in order to start accumulating. And if you go back here, people line it up from different areas. So if I show you the Fibonacci levels here, you will see that, from the low here in October, okay, if you go all the way back down to this low, which is what I like to use here because I feel like that's the day the rally started, the fib retracement takes you to 25% off the highs, which was right here, which tried to hold. But I think that's just too shallow. That shows you a really, really strong market, not a lot of problems, but we have a lot of problems. So the next level takes you to the 38.2% retracement, which brings you right around 1291 to 1300, and that would pretty much be the measured move of this price pattern. So with that being said, even if we held, just say we held the 38.2%, we held above 1300, that shows you that everyone might be crying bloody murder, but that's still showing you commitment to the rally that started on October 4th because a 38.2% retracement is not a huge retracement. Sometimes you even go 50% and you can continue higher. So to me, I think we're not going to get as disastrous as we saw last year, 22% off the highs, but there was no reason to stop and think that 4 to 5% was enough.
Right, and I think you got to look at the usual suspects as normal, look at the leaders, but then also another clue is the Russell. That kind of made some moves last week too.
Well, if you remember, I think one of the titles was faulty signals last week. That's when the Dow was leading us higher. That was when tech stopped with the baton and passed it over to the industrials. You know how that goes. It's like a general going into battle without its troops. And then the Russell also was lagging. And you don't want to see that. You want to see the market led by the small caps, led by growth with technology. And if you look here at the IWM, you will see it's at a very big level here. Okay, you have a high, a lower high, another lower high. Same type of pattern here where it failed, right at this pivot. And remember the Dow Jones that was making new highs, the Russell wasn't even near it, and now we're at a lower pivot right here. So if the Russell starts to get below, or the IWM gets below 77.97, and we close below it, you're going to see move down to this prior breakout, and probably just where the 200-day is, and this will be that void, and sometimes it happens really fast. So watch that Russell as well for clues.
So in this sector spotlight, I want to get into technology. It was the worst performing group last week, but there were some winners and losers, and we have the Facebook IPO later this week, so hopefully that'll help re-energize the group. But let's start with, we got to start the conversation with Google. I think this stock traded down after missing earnings in a big way in April, but it seems like it's been able to stabilize, maybe off of the Facebook IPO, I'm not sure, but the fundamentals there are still kind of worrisome.
Well, you miss 2 quarters in a row, and people start to lose faith. With the Facebook talk and valuation talk, people have been saying, oh, you know what, Google looks a little cheap. So for me, I still think it's all right for macro investors. It's still holding the 200-day, but for traders, it's very, very choppy. Last week, if you look at the chart here, I tried a few times to actually get long it for a trade. And then every time I tried to get above this 615 area, it wouldn't go, and it was very, very frustrating. So, the market at these areas have been proving that you could buy versus a 200-day, but anytime you want to add for momentum, you're getting hurt. So for now, I would say defined resistance is around 617, and then you have the 200-day. If Google starts to give way here and it starts to get below this, just say, ascending channel here, I think some traders are going to try and get shorted, especially if you close it below the 200-day. You have a high, lower high, big move down from earnings, not really able to take most of it back. So at this point, if you're a long-term committed investor to Google, that's fine, but short-term traders don't have commitment. If it breaks below 598, you could short it. If it breaks above this, obviously the market's not going to be having that much downside, and some of these high beta leaders will probably be leading the way.
How about Yahoo? Activist investor Daniel Loeb with Third Point is in there, and we got some news over the weekend that the CEO was resigning and that Loeb was getting 3 board seats. Maybe with his involvement, now that he's on the board, they'll be able to turn this around a little bit better, but you think it's kind of a non-event?
Well, it depends. If you're a Yahoo lover and you're in there, maybe you'll be happy. An activist will do something, but I don't think this is so big for the market. And if you look at the chart here, I actually like the chart because it's tight and it's a nice channel. So if you look at ever since late September, it's been going sideways and just pretty much consolidating anywhere between 14 and 16. If you remember, it was supposed to be taking over 32, but they didn't like it there. They wanted 34. Well, now look at it. I think if anything happens here on the takeover side, I'm not going to speculate because I'm not an investment banker, but I would say nothing's going to be north of 21, 22. So some guys are saying, you know what, let me get involved. I'll stick it out. I have a long time frame. That'll unlock the value. And, if that's what you want to do, fine. I guess if it were to get above 16 and show huge volume and look like a good breakout, maybe I'll get in there for a trade, but I'm not going to sit long Yahoo for a takeover.
That makes sense. Apple is another one. They've been a leader. Last Friday, we heard from Credit Suisse. They took estimates down just on slower smartphone growth potential. But this one's been hovering around the 555 range. What are the technicals you're looking at?
This one's been a great vehicle for cash flow, and I've been focusing on this a lot. If you recall a few weeks back when it broke 620, it was showing relative weakness. It was a good short. Then it gapped up into earnings, and since then, it's just been meandering lower. I think this is something really good to have on your front screen to trade and as a gauge, because right now, if you look at the chart here, Apple's trying to bang out that support like you just mentioned, Lindsay, right around this. This was the low here. This was 555. It's been trying to bounce in this area off of just say this 560, and it's had a lot of trouble. Same like Google, I tried to buy this right here. Remember this 572, but I was like, you know what? They're letting us buy it in the hole, but anytime you add to a position onto strength, you're getting frustrated. Rightly so, maybe the market's saying it wants lower prices. So now you have defined resistance around 574-ish or 575. Here's your support. And if it starts to break below 561, I think some traders are going to start to cheat short, especially if you get a close below 555. Then the next area here is this is actually 532. I think it can go even lower than that. I think 516 would be a spot. So if we do start to break here in Apple, you're going to see some more acceleration to the downside. If it holds, then you'll probably see a lot of action like we saw last week, where you could buy in the hole and sell strength. And it's a frustrating trade, but it could be profitable if you do it well.
Definitely one to watch. And speaking of Apple, let's talk about Qualcomm. They're a key supplier for Apple, and they've been a leader through the first quarter. But what are the technicals looking like?
This one, I don't think I've traded in like 4 weeks. It was one of my go-to stocks. It was in my portfolio approach, and you stay with it until it changes. And if you look up here, it got very choppy. Look in this range. You had this upper range up here. You had a big green day met by a red day, and then a day that tried to break it below, but it couldn't go. And then all of a sudden, it wedged into I guess this was earnings, and I guess they didn't like what they saw. So what you saw is a gap down on whatever news this was. I don't even really remember. But PS, it came down, came back up, couldn't fill this gap. So this is showing you that the sellers are still in control. So the question is, I guess the question like everything in the market is, can it break bigger support? So your defined area in Qualcomm, the low here is 61.25, this one's 60.86. So write this level down. If we start to break below this area, you could see a move down to 58, which would be very hurtful for the market, or maybe even down to the 200-day, which is right around here. I guess let me just real quickly put in the 100-day, because some of the strongest stocks will hold the 100-day. So if this is strong, and just like Apple, which I'll take a quick look there too, the 100-day is something that a lot of hedge funds use. Right now, it's actually already breaking or at the 100-day. So a close below this level, there's really nothing in its way down to the 200-day. And just real quickly to revisit Apple, that 100-day stands around 522. So it's showing you that Qualcomm is weaker than Apple right now.
And then, so those were some of the bigger names that actually performed well last week. Some of the weak names last week were Cisco. That was like an earnings guidance issue. Juniper and F5. I don't know if we want to take a look at those quickly.
Well, I guess we could take a quick look at Cisco. Cisco, I tried to delve in a little bit more. A lot of guys are trying to blow this off and say, oh, it's a Cisco problem, da-da-da-da-da. To me, it really wasn't. To me, it showed me the fact that one of the biggest companies in the world, growth was slowing in Europe, and also our little deficit reduction here in the public sector showed you that orders were slowing. And if you look at the pivot low from the earnings, that was right here. That low there was 1676, so that couldn't even hold it. So I would say the next real big level for this to turn back into a fundamental play or a value play is all the way down here at 15. So that's the next time I'll consider Cisco.
Yeah, that's interesting. Well, we're going to take a short commercial break, and we'll be back we're going to get into the trenches with the banks.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
We're going to get right into it with the banks and JP Morgan. Obviously, last week, this is a big news stock. They reported that they were going to take a $2 billion trading loss in the quarter. This was pretty disappointing to hear, especially coming from Jamie Dimon, who's one of the most well-respected CEOs in the industry. Jim Cramer and Stephanie Link own this in the Action Alerts Plus portfolio. They're viewing it pretty much as dead money right now until the next earnings call, which should be pretty good. You owned this last week, didn't you?
I did, for a trade, and thank goodness I took that trade, which is what I've been doing in this market, and that's what traders are doing to stay safe. Tactical trading. And I actually was long overnight on I think it was Wednesday into Thursday, because I was playing a bounce, so thank goodness I wasn't in there for the Friday melee, but I wasn't there, so I was able to tactically make money off of it. I was tweeting about it. I was actually on the road. I'm like 36.50 to 37. That's an area that's a 200-day. Typically, you bounce off that first. So I got long, and you're able to see like $1. It was like 2-3% as a trader. As an investor, it was hard to see this coming because JP Morgan is a white shoe company. JP Morgan, I still like Jamie Dimon, but I think what happened was this trade just got out of control, and they let it get too far. And they were betting actually on the U.S. economy recovery and a world recovery that started to falter. I'm not going to get into it. One other thing I'm going to say is I love the fact when these people come in, get paid $10 to $15 million, and then they are allowed to resign. So, okay, you guys don't have to deal with the problem anymore. You go on vacation, go lay low, get out of the press, count all your money, and let someone else who's not familiar with the problem solve it. Anyway, good for the press, bad for the company, bad for us. Look at the chart. That's what I'm going to watch. I'm not going to look at all the crazy baloney underneath the surface. But if you look here, 36.62, that is the pivot. That is the 200-day. If we start to get below 36.62, and close below it, the next real level comes down at this gap around 34. This will give us some clues to the market action. If we can't hold this low and it starts to accelerate again to the downside, this will bring pressure on the banks, and this is something that could be a problem spot, so we could look at that. And then let's take a look at that, I would say, with what, the XLF?
Let's take a look at the XLF, see what the group's doing in general. Where are they trading? Are they near the 200-day? Or?
It seems like the XLF is holding up better, so it's showing you that they're not really punishing the entire sector for what JP Morgan, what happened there. But if something happened like that at JP Morgan, I wonder where else it's happening. But anyway, I'm not going to be that kind of conspiracy theorist. If you look at the XLF to see important levels, you can see that the XLF came off the lows. That's why it went green. The XLF actually is holding around the 100-day, which is higher than the 200-day where you just saw, what's it called, JP Morgan. So at this particular point, it's hanging around. If you start to see people lose trust in this area, which could happen, and we start to take out the low here of 1464, that is 1464, you're going to see pressure in the market. Next big level is this lower pivot right here, which isn't too far down, that's 1440, but if you go all the way down to the 200-day, that's when you're going to start seeing people getting really scared. So watch this level short term today, and then we'll see how deep this type of retracement correction goes.
How about we take a look at Morgan Stanley? This one's been a weak stock anyway for a while now, and the biggest looming concern is a potential credit downgrade by Moody's. Management was out last week saying that if they got the downgrade, that would force a margin call of over $7 billion on some of their derivatives contracts. Again, another risky area to be in. But what does the chart look like?
Well, everything you just said makes me want to say, why would I ever touch this stock? I know Bouvet came out a few weeks ago and said this is the cheapest one in his books, and typically he upgrades stocks after a run, so at least he talked about it in the hole. If you look here at the chart technically, it hasn't reacted well this entire year. It's below every moving average. They're actually all curling down. I guess as a trade, I've tried it a few times and I've actually lost money. No, not actually, I lose money sometimes, like us all. But you could say it's coming into a level. If you want to trade it long, versus this pivot low here of 1470, that's fine. You could have a move up to fill this gap up to 1585, but if this gives way, your next point of reference here is the low of about 1403, and then below 1403 gets real ugly down to 13. So use this to trade against today, and then you have 14, and then you have this. But I really see no reason why you should be jumping into Morgan. Maybe towards the end of the week with Facebook coming up, and they're involved in the deal, and they have the fees and this and that. Maybe there'll be a trade there, but for an investment, I just think that it's a lot of risk.
Steer clear. Well, that's the bad news. The good news is that the regional banks have been doing actually very well. They've been rewarded over the year for having less international risk. Two stocks that have done really well are U.S. Bancorp and SunTrust. They were in the green on Friday when the rest of the banks were down. But Stephanie Link likes USB better than SunTrust, but she owns both, and that's for the consistency, the loan growth, and the solid balance sheet.
Okay, well, when I look at this chart, I see a different story here. I see a stock above its moving averages. I see accumulation. And obviously, in the banking, there's going to be collateral damage. Everyone's going to try and put them all in a group together. So if stocks could keep, I would say, performing on their own merits, which you're starting to see a little bit more of a macro trade like we saw last year, where everything goes up, everything goes down. But with like Friday's action, at least they rewarded guys saying, oh, USB has been stronger, it doesn't have as much exposure. You look at the chart here, you will see that from a level like this, on a technical level, it just came back and retested this breakdown. So macro-wise, here was the breakdown, came back up, put a small double top in. So right there, to me, that's a little bit caution. On a short-term side, it's above the 100-day, above the 200-day, still showing some nice support here. So I wouldn't be running for the hills if you're a macro investor. I would say this green day is good, but I don't think that they're going to let any banks, even regionals, break above resistance. So at some point later this year, if the rally resumes, I would say momentum could come in and you could be a buyer above 25. If you're an investor, stay with it. But if you're not that committed, you see this uptrend here. If USB starts to break below 22.67, I think that you could, step aside and wait for some type of reversal strategy or some type of market that has a little bit more clarity.
Did you want to touch on SunTrust at all?
Let's take a quick look. And
another regional.
SunTrust. I think SunTrust is the one I just went over. I'm sorry. So USB.
Okay.
There you go. Sorry, that was SunTrust, and here's USB. USB, actually, to me, technically looks a little bit better, but we shall see. Here's a little bit of a reversal day. If you look at this uptrend is still intact. But if you're not committed to the banks, if you're not committed to a portfolio approach, and you're not committed to a macro holdings, if it starts to break below this 31.20, I would say get out of the way and let's wait for a better market. But technically, it's acting really well, but it's hard to trust anything in this market, even if it's technically acting well.
Right. Why don't we go into some quick hits? We'll kick it off with Bed Bath & Beyond. They had a strong week last week on the news that they were acquiring Cost Plus. Can this one break out to new highs?
I don't know. I just punched up the chart. I haven't traded this, and it's interesting to see that they are letting some stocks get to new highs, but these breakouts have been more distribution versus accumulation. Sometimes you get a breakout and then you get 2-3 more days. Lately you get a breakout and then it's a failure. So be careful here. Look at the chart. The chart looks good. You're right at the old highs. It was really strong on Fridays. It's very strong above the moving averages. Hard to fight this one. Doesn't mean you have to be all in, but if it starts to get above 72.42, let's take a broader view here. What a strong stock, my goodness. Okay, still looks good. A lot of people going to Bed Bath & Beyond. I know my wife does.
Yeah, especially with the new house, right?
Yeah, there you go.
How about Expedia? They were able to hold the gap up that they got after earnings.
This one is on, a lot of my guys talk about it because you have the gap up in earnings, it hasn't filled it, the range is getting tighter, so that means we can get a calculated trade. If you look at Expedia, you will see still holding this earnings gap. A lot of people are still non-believers there. I don't really believe in it either, but I'll just take this flag type pattern and I'll take the name out of the way. If the market stabilizes here and we don't go much lower, we get above this 42, you're going to see another squeeze. So 42 could be an entry, and then over the highs, if it starts to fail and starts to get below the low here of around 40 or so, maybe it starts to fill the gap and gets pressured if the bulls lose the ball there. But getting tight here, it's almost ready. Maybe another tight day or so, but I would say, again, even making it tighter here, this is your level to the short side, and here's your level to the long side. Don't even know that it's Expedia. Take that out of the way.
What about Alta? This one, it's a smaller stock name. It's a smaller cap name, but they were able to trade up, and they successfully priced a secondary offering on Friday on a weaker market.
I'm just going to avoid it. I'm not even going to put the chart up.
Okay.
Let's just go. Keep going.
It's just too small. Okay, let's talk about Arena. This stock was up big on Friday because a panel suggested that the FDA approve their obesity drug, which most expected. This was a surprise. So,
I think that if you were in it and you were playing for it and you had analysts on your side telling you about what could go on, the risk, the reward, you got rewarded. And with a lot of these pharmaceuticals, these bios, a lot of the move happens with news. So just know that you're in there for the news and that you have the risk for the news. And if you take a look at the stock now, I think it'd be nice to see if it could create a new range here. It closed off the highs here, but when we talk about earnings gaps, sometimes you have big news gaps. So longs could trade this verse. This low here of 576. If it starts to break 576, maybe it fills a portion of the gap and the excitement was a little bit overboard. But then if it can go sideways and hold that, you have a lot of shorts trapped, and then here's your entry. We start trading above the high of that news day of 701. It can continue. If you go quickly to the weekly chart of this, you will see, very, very choppy, sloppy type of action. It just took back what crushed it. So on a long-term basis, if it can go sideways in front of this, again, I would think that it could have higher prices and you could see 12 ducks, 12 ducks, quack, quack, or 12 bucks, if that's your long-term thesis. So make sure that gap holds.
What about Duncan? This is one that you've been watching pretty closely.
This one's acting very well. And, for guys I told to put in their 401k or their macro account, because as an investor, you have to know you're an investor, because if you're an investor, that means you're not trading every week, you're not trading every month. So if you sell a stock, sometimes you don't revisit. So at this point, I would say Dunkin' is one of those stocks that if you have a long-term plan, I think you could stay with. You know, it has a lot of my criteria. It's a new issue. It came public within the last year, so you have institutional support by now. It traded above this area. This was the first time I got really excited about it, above 30, went to new highs, made new IPO highs. Then it had a secondary, so it had to absorb it down here, and now it closed almost on the highs. Okay, so to me that's showing that it's not waiting for the market. To me it's showing that at some point in the next year to 2 years, this thing could be north of 40 bucks. You have a little McDonald's, you have a little bit of Starbucks, everyone loves their product, they're expanding now in India and all over the world, so why won't this that just came public, you know, do well over the course of the next 2 to 5 to even a decade from now?
Everyone loves their coffee.
Yes.
But so as far as trading today goes, you know, it's good. It seems like this week is going to be a bit choppy, just like last week.
Yeah, I would say at this point, I know what works for us. Either there are 2 ways to do this, or 3 ways. If you're of a very short-term approach, micro scalping is working. You know, trading versus the prior pivot. We talked about 3 or 4 pivots in the course of the last week. They were good to use from the long side, and they were also good to use from the short side. So for today, my micro pivot is 134.49. That was the low of the last week. We're opening right below it. If we hover below that pivot for 60 minutes or so, you could be short versus that, and then maybe we start cascading to the downside. Maybe some of the stocks we talked about start breaking those levels to give you acceleration. If we get back above that 134.49 in the first 15, 20 minutes, maybe try a long versus the morning low. Did that on Friday. It was a very good trade. Spiders wound up going almost $1. Made nice tactical cash flow. You could have done with a lot of different things. But that's how you do it. You keep it simple. There are guys who are just cost averaging into short, saying, you know what? I agree with you, Red Dog. No reason why 5% off the highs is going to work. We're going to be down at 13.20. We're going to be down at 12.95. And I do somewhat agree with them. I said 75%, we hit 13.20 when we were around 13.70. So I agree, but if you're going to do that trade and you're going to cost average into it, you have to have more money behind you, more risk behind you, and that means your convictions are high. So just know which type of trader you are. For me, I'm going to trade both long and short, but I'm not just cost averaging short every move. I'm going to trade both ways. And once we get to some of the target areas, 1300, 1320, then I'll start to see how the leaders are acting, and then I'll see if that 9 or 8% is enough, and could we start putting back a portfolio approach based on a pattern of a new move. But if we don't see that pattern and things continue unraveling and things start going, the contagion comes in, because it does feel a little, unfortunately, like 2000, 2008, with the news we're starting to get, then maybe that level doesn't hold, and I guess we could see another summer soon. But you don't have to know that yet. You just have to be in the right position to see what's going on clearly so you can react positively.
So there's your key levels that you got to be watching today and this week. Just know what type of trader you are, and be sure to check in at the end of the day with Scott and T3 Live to get the daily recap.